Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend it with us. Well, I think investors are definitely breathing a bit of a sigh of relief. Recently, we've seen markets really bounce back from the first quarter of this year. I guess markets really started to move first, second week of April. And I guess somewhere around third, fourth week of April, we really started to see a surge. And this surge has been on the back of trade negotiations out of the U.S., between the U.S. and certain countries. And we've been hearing a lot of rumors about trade deals and investment deals, a lot of investments coming back to the U.S., a lot of money being spent, a lot of manufacturing and manufacturing coming back to the U.S. Business has been, as the president says, booming for the United States. A lot of business, a lot of corporations promising to bring business back to the U.S. And we've seen how that has affected the U.S. stock market and really the markets all around the world. And overall, I think today's show, we're going to talk about a few investment themes that I've touched on in the past. But I really want to bring the message home to everybody that this was obviously a very crazy time for investors, the first, let's call it 4.5 months of 2025. But it should show us and teach us a lesson about investing, a lesson that we come across every now and again, back in the financial crisis, back 2020 as well, 2022. And these are the lessons of investing. Markets just don't go straight up. There'll always be periods of time where they go down, and we just have to make the most of the situation. And like I always say, better your portfolio at that time. So let's put up our list for topics for this show. There you have it. Market surge after the U.S. and China negotiate a 90-day tariff de-escalation agreement. Now, I won't say they have a trade deal, but the good news is they've agreed to lower tariffs on each other for a period of 90 days so that they can negotiate. Because as we know, when tariffs are applied at outrageous rates, 145% or whatever it was that the U.S. was applying on Chinese goods, that effectively just shuts down trade between the two countries. You have an embargo. So bringing down rates, bringing down tariff rates allows the countries to continue to trade while negotiations are happening. So we'll talk about that. Top 3 things to consider over the next 5 to 10 business days, a very popular part of our show. I'm going to go through 3 ideas, 3 themes that individual investors should be focusing on. Key takeaways from the latest market decline and then rebound. And as I just said off the top of the show, a very important part of our show today. We're going to go through a couple of good visuals that I think really tell the story. And I'm hopeful that investors will understand. Plus minuses, so the pluses and minuses of the U.S.-UK trade deal and the U.S. trade deal, or at least the discussion of creating a trade deal with China. How does that affect the rest of the market? How does it affect certain things in the economy? We'll go through those. When does the Fed take action? When will the Federal Reserve lower interest rates? A lot depends on that. And the U.S. dollar, overall interest rates, mortgage rates, etc., obviously depend on if and when the Fed will consider lowering rates. Quick hits, 3 ideas, as always, that I like to talk about that are in the news right now. I will give comments about those. And last but not least, as always, your questions. I always like to take 1 or 2 of those and try to answer, as many questions as I can from the audience. If I don't get to your question on the show, this show, perhaps we'll take care of it next show, or sometime between this show and next show over the next 2 weeks, I'll be answering a bunch of your questions. So without further ado, let's get on with this information-packed show. So after the negotiations between the U.S. and China, both countries had sent their top delegates to Switzerland over the weekend, and they at least hammered out a pathway forward. They brought up, I know on the U.S. side, brought up a number of things that were concerns for the U.S. Their head negotiator, Jamieson Greer, along with Treasury Secretary Bessent, talked with China about what they see or what their concerns are. And the good news out of their meetings over the weekend were that the tariffs were going to be reduced. So U.S. tariffs on Chinese goods coming into the country would be reduced from about 145% down all the way to 30%. And that 30% pretty much is made up of a 10% tariff that all countries probably will have even after the US negotiates with each individual country. So, kind of a baseline tariff, plus the 20% tariffs on fentanyl. Remember, even here in Canada, we have tariffs on fentanyl or due to the fentanyl coming across the border. So, perhaps once the Chinese take care of the fentanyl issue or problem, maybe their tariffs drop down to as low as 10%. So that's something to look forward to. On the China side, they dropped tariffs all the way to 10% on American goods coming into China. Keep in mind that hundreds of billions of dollars exchange hands from China to US on an annual basis. I think it's somewhere around 600 billion or something like that. So by far one of the largest trading partners to the United States, them, Canada, Mexico, the three top trading partners. So bringing down those tariffs is definitely key. And one thing that doesn't get a lot of mention was that China stopped or made an announcement that they were going to stop buying planes from the US, from Boeing, and they have now or since taken that off and have decided that they will start buying planes from Boeing once again. So pretty good for Boeing stock. Shareholders have seen stock in Boeing move higher recently. And with the recent deal out of Qatar just this morning, the biggest deal for Boeing, I think in its history, buying over 200 planes from Boeing. Boeing stock has definitely rallied off the lows. But overall, a lot of people are asking the question, is this, negotiation with China, is it a short-term win or could it be a longer-term win? I really think it's in the best interest of both countries to make it for it to become a longer-term win. I've talked about, jokingly a few times about the president talking about who has the cards, right? President Zelensky in Ukraine doesn't have the cards to go up against China, and they need the US. And he talks about the cards, who has the cards to negotiate. I guess President Trump, he may be a great poker player because I think he's a good bluffer. Because when he tells you he has the cards, well, sometimes I'm not so sure that he has the cards. I think the market, the stock market, the bond market have the cards. And in this case, perhaps the trade itself, the economy itself has the cards. Because what we've seen recently on the China side, a lot of businesses, because of the high tariffs, a lot of businesses in China starting to implode, starting to go under. A lot of people complaining in China. But we're also seeing this play out here in the United States, or not here, but in the United States. And where are we seeing it play out? At the ports. Normally, you would bring in, there'd be a lot of activity. You'd bring in a lot of goods from Asia, from China. China is down quite a bit, goods coming into the US. But overall, the ports on the West Coast in California, they've seen activity drop as much as just over 30% activity drop. And what does that mean? Well, eventually, if that doesn't get fixed, it means loss of jobs. Obviously, port workers, but also businesses in general, the trucking companies that ship the goods from the ports to the businesses, and business in general. If these ships are coming over, if less ships are coming over, and we've seen that already, if 3 ships would have come over, normally we're seeing now only 1 docking in California. These ships are coming not full. They are coming partially full. So that could mean empty your shelves, right? Empty your shelves at your retail stores. And make no mistake about it, I believe, and actually Treasury Secretary has said that he is aware of what could and what is possibly going to happen. I think the President of the United States knew how long he had to make a deal with some of his major trading partners. And I think that time is coming up. And I believe that a lot of businesses had inventory that would last maybe 3 to 6 months. And here we are, the 5th month of the year. So come end of May, you could see or start to see some emptier shelves. So probably not a coincidence that the United States is starting to make some trade deals, trying to make headway on some trade deals. And listening to some of the CEOs of those ports in Long Beach, California, and other ports, you're hearing that It probably will take 2 to 4 weeks before things get ramped up again, because we know it takes about 2 weeks for a shipment to come across the ocean from Asia to those ports in the US. So not a coincidence that deals are starting to be spoken of, and the market loved that. On Monday, you saw the markets higher by roughly 3% in some areas and as much as 4.5% in other areas. Our first, I guess, couple of visuals. Our first one is the S&P 500 index. There you have it. And you can see what has happened once the China trade conversation started to come up and the tariffs were significantly reduced. You see here that first week of April, market hit a low just after the reciprocal tariffs were announced at the beginning of April, had a bit of a bounce back, but then kind of retested those lows, let's say third week of April. But really since then, the markets have been moving up significantly. The S&P 500 has moved up, and its last leg, that far right-hand side of this chart, that is when the negotiations and the tariffs were reduced on China, on the US, and the market really liked that. The next chart we have is the NASDAQ, which is more tech weighted and tech heavy. And you can see almost identical chart. And again, on the far right, maybe the line is a little bit steeper because tech really benefits when tariffs are removed or reduced on Chinese imports. Our next visual here, you can see it's more of a headline. And it's a headline saying, container shipping firms call Asia-US service as Trump tariffs collapse trade. This is when, obviously, the high tariffs were announced. Trade, in essence, had stopped between China and the US. When you have 145% tariffs on anything, not much trade going to happen between those two countries. Our next headline, I believe, came from CNN. And here it is. For 12 hours, 0 ships left China bound for California's top ports. That hasn't happened since the pandemic. So you can see there were periods of time where there were no ships leaving China, very few ships leaving Asia to these ports in California, obviously definitely causing some concern in the United States and with the president and Treasury Secretary. However, our next headline, this is what's happened since I guess the trade deals, our negotiations have started with China. Our next headline, we're starting to move everything. Trump's China deal frees up shipping. The temporary lowering of tariffs may compel some U.S. businesses to order goods that they had held off buying after President Trump raised them to 145%. So this is all the activity that is starting to happen once again. You're starting to see business flow once again. And this is all on the back of this 90-day pause, lowering of tariffs. Obviously, there's still some uncertainty. We don't know where things are going to go with respect to the trade negotiations. We hope that they can come to some agreement. We don't want to go back to the days of high tariffs. I don't think both the US or China can afford to do that. So I'm really looking forward to hearing what comes out of trade talks over the next couple of weeks and continue to see a lot of business between those two countries. Now we come to the part of the show that I know a lot of people like to watch. And this is when we talk about the top 3 things that individual investors should be focused on before they make their investment decisions. And I think for this show, we actually have a few different topics. Normally we talk about the Fed and economic data, but this time, because of the way the world is moving today, the economies are moving, it's moving a lot on and with respect to trade. So what are our headlines today? First one, looking for the next big announcement or trade deal announcement. There are announcements coming out of the US on a daily basis, sometimes from hour to hour, different businesses, different announcements out of the White House on tax, on trade, on tariffs. It's a whirlwind of activity, definitely. So that's something I want to touch on today. Be mindful of which sectors are in the US president's crosshairs. Which sectors of the market is President Trump focusing on? And as he would say, focusing on fixing that he thinks are not working properly, that he would issue an executive order to, and that may affect these sectors. We're going to highlight a few sectors that I think are in the president's crosshairs that you may want to avoid or at least underweight in your portfolio at this time. And our last point, one that we seem to always talk about, NVIDIA earnings. NVIDIA earnings will come out towards the end of this month, and they're obviously very important. NVIDIA right now, not the largest company in the world at this point. Microsoft has taken that number one spot, but NVIDIA is right behind, becoming once again a $3 trillion company. We've seen the stock price surge to $130 and beyond this morning. And with NVIDIA making trade deals, most recently Saudi Arabia and the hyperscalers, the companies like Amazon, for example, still buying billions and billions of dollars worth of chips. This is a name that we all need to focus on. So let's get to our first topic, which is trade deal announcements or announcements out of the White House. I think this is something that individual investors need to focus on because any announcement of some sort of trade deal will definitely move markets. And our first headline actually comes from a statement, NVIDIA statement on reports of Trump administration AI policy change. And here it is. We welcome the administration's leadership and new direction on AI policy, with the AI diffusion rule being revoked. And I'll explain what that is. America will have a once-in-a-generation opportunity to lead the next industrial revolution and create high-paying U.S. jobs, build new U.S. supplied infrastructure, and alleviate the trade deficit. And if I'm not mistaken, I heard Jensen Huang, the CEO of NVIDIA, make this statement. And what the diffusion rule was, President Biden put in this rule, and the rule was basically that they were going to divide the world into three pools. Number one would be allies, the countries that the United States consider their closest allies. They'd be able to get the best chips out of the US, the fastest chips, most powerful chips to do what they needed to do. The next grouping of countries may not have been the closest allies, but allies nonetheless, nothing, no ill will between the US and this group of countries. And so they would be willing to get, or President Biden said they could get the next best chips, maybe not the best of the best, but maybe the second best, so not as powerful. And the third grouping of countries would be the countries that the U.S. considers an enemy, not an ally, and they wouldn't be able to get any chips. So this was how President Biden, called it the diffusion rule. Well, what the U.S. has done now is said, basically, we're doing away with the diffusion rule. We're going to let companies like AMD and NVIDIA be able to negotiate with any country that they want. And there will be certain countries like China, for example, that if you want to do business with China, you will need a license to do so. So they're controlling it based on this idea of gaining a license. The government will issue a license with respect to what type of chips you're sending to places like China. And that's how they're going to monitor the situation. So definitely a headline that move markets, is helping the chip makers, and it's something that individual investors need to keep in mind or be mindful of. Another headline, or in this case, a trade deal announcement, was the trade deal between the US and UK. And we have an illustration that talks about that. There it is. So when that headline came out, I believe in the Oval Office, the president brought the Prime Minister of the UK on the phone, and they talked about the deal, and the market loved it. Market moved higher that day. You can see here, new market access for the United States, $5 billion. They can also, interesting enough, if you look at the far right-hand side of that illustration, they now have a 10% tariff on the UK, whereas before they had a 3.4% tariff. So they've actually will bring in revenue from the UK, even though they have a trade deal, or more revenue from the UK, which is, I thought was interesting. On the other side, the UK had a 5% tariff, and now they're going to have less than 2%. So it looks like when you look at this kind of deal, and I've said this before, where exactly did the UK win? I'm not so sure, because they're going to be paying higher tariffs, and they're letting the US pay lower tariffs to gain access to their country. Unprecedented access to UK market, there you have it. Ethanol, beef, cereals, fruit, vegetables, a whole list of things that they will have access to their markets. Steel and aluminum trading union, tariffs and quotas, and all the information right there for you. Secure supply chains and pharmaceuticals. One of the things the UK benefits is on automobiles. They're going to be able to ship automobiles into the US at only a 10% tariff rate, Whereas right now, if you ship autos to the US, everyone else is paying a 25% tariff rate. So a lot of the unions, a lot of the car manufacturers like GM and Ford, not too happy about that, because if they bring in a car from a Canadian plant, 25% tariff. If the UK brings in a car, it's only 10% tariff. So there was a few ruffled feathers when that announcement was made. So definitely want to keep abreast of these trade deals, trade announcements, announcements in general. I think they're going to be big. As I said, announcement this morning with Boeing, 160 planes or over 200 planes when it all is said and done. Deal with Qatar for Boeing, and we've seen the stock of Boeing move significantly higher as of late. Our second point that we wanted to be mindful of with respect to investors making individual investments into different areas is this whole idea of who's in the crosshairs of the president at this point. We've heard a lot of announcements, a lot of executive orders, but going forward, where do we think it would be a little bit difficult to move into for investment purposes? Maybe you want to be underweight or have no investment in some of these areas. And I want to talk, the first one I want to talk about is pharmaceuticals. And recently, we've heard the president talk about, we can bring up the U.S. pharmaceutical ETF. There it is. Pharmaceuticals have had a tough time in the markets, stock market for this year, last year. Pharmaceuticals have been kind of out of favor for a little while. That recent surge you see on that chart, a lot of it had to do with Eli Lilly and their GLP-1s, their weight loss drugs, diabetes, etc. Eli Lilly makes a huge makes up a huge part of this pharmaceutical ETF. So when you do see a surge, sometimes it's based on just a few of these pharma companies, but the majority of them have definitely been struggling. But recently, as I was saying, the president has said he wants to see drug prices down. And he put an executive order saying that the United States, the people that live in the US, should not pay more for their drugs than the lowest, than the country that is costing their people the lowest amounts for the same drugs. So what does that mean? Well, if the UK, a drug here in the United States is more expensive than, let's say, in Canada or in the UK or somewhere else, then the United States put an executive order saying that that drug has to have their price lowered to match what it is in Canada or the UK or any other country. So they're going to shop around the world, see where this drug is priced the cheapest, and the US must match. Now, stocks of a lot of these pharmaceutical companies dropped initially, but then surged forward. And why is that? Well, we quickly realized that it's the middlemen, the pharmacy benefits managers, the ones that set the pricing. They're the ones that were going to be affected most, not necessarily the drug makers themselves. So that was the first thing we realized. And secondly, you don't have to necessarily drop the prices of drugs in the US if you raise the price of drugs in those other countries. So if Pfizer raises the cost of their drugs in the UK or in Canada, then they don't necessarily have to drop the price in the US because they will match. So it's more of a equalization, I think, as the president called it, for pharmacy. But definitely pharmaceuticals are and have been, at least as of late, in the crosshairs of the president. The next chart we have is on energy. And I believe energy or oil is down again today. That has been in the crosshairs of the president. Now, he may not agree or admit to it, but all he talks about is trying to lower oil prices, energy prices, so that he can bring down inflation, because he knows his other policies, reduction of tax, deregulation, tariffs, that increases inflation. So he wants to try and offset it with a decrease in energy and fuel costs. So we've seen on this chart, you can see price of oil actually starting to move higher. And that is based on the idea that trade negotiations are happening. And if trade negotiations are happening, that would be a good thing for global GDP, and oil moves up based on that. But in my opinion, make no mistake about it, I think that's a short-term phenomenon, and I would not be surprised to see oil fall back below the $60 a barrel mark. Another area I believe is in the crosshairs of the Trump administration is this retail companies like Target, Home Depot, Walmart. And why I say that, again, it's more of an indirect effect. And that's because these companies get a lot of their supply or their product overseas. China, number one. And so putting tariffs on these companies definitely causes many of us who own these stocks to have seen a pretty, I guess, poor return, to say the least, on many of them, whether it's Target or even the Walmarts of the world have seen their stocks fall, etc. And again, recently, as you'll see on this chart, things started to move up again because of the idea that the United States was talking to China, that hopefully a trade agreement will come out. If one doesn't, I think you'll see a reversal and this chart start to come back down. So to me, I think these are three areas, in my opinion, three areas that I've underweight for investors that you may want to consider to underweight in your portfolio: pharma, retail, areas, energy, areas that I think are in tough. Our third point, again, that we want to talk about before individual investors make their investment decisions, and this is the idea of NVIDIA and their earnings that are coming out shortly. NVIDIA earnings will be released in the next week or two, and as being the largest chip maker in the world, $3 trillion in assets, this is going to be a market mover. If NVIDIA says earnings are slowing, revenues are slowing, that will definitely not be good for other chip makers. That would not be good for chip equipment makers and tech as a whole. We have a couple of charts here to round off our segment. One is NVIDIA, one-year chart. You can see the steep increase. I think NVIDIA is up like 40% in the last, let's call it, month or so. Unbelievable run. If you look at it on a 5-day chart, which is our next chart here, you'll see that it's done exceptionally well as well. So NVIDIA earnings are coming up. Keep one eye on that. I think you want to be mindful of where the president or what the president says with regards to other sectors in the market. And you want to look at where or listen for the next announcement on a trade deal. I think those are the three things individual investors should be focused on over the next few weeks. So what takeaways can we, I guess, learn or what can we take away? Probably a better way of saying it, from the latest market decline and then most recent rebound. I think if you look at the market as a whole, and I always talk about the S&P, and if anybody's wondering why, S&P 500 companies, biggest index in North America, a lot bigger than the TSX. Toronto Stock Exchange is just over 200. The Dow Jones, that gets referred to often, 30 stocks. So the S&P is really the main index to look at. And when you look at the fall that we had, S&P went into a bear market, basically down almost 20% from the high. If you look at how quickly the S&P 500 rebounded, it was one of the fastest rebounds from a bear market that we've seen in 40 years. This market rebounded that quickly. And I've said many times on our show here, on my radio show, BNN, everywhere, right across the board, I've said that this decline in the markets was man-made, actually made by one man. And it could easily be rectified and things could turn around if that one person, President Trump, were to make some announcements or do the things that he needs to do to get the economy back moving in the right direction, get trade back, and get stock market moving in the right direction. So at what point did the pendulum swing from being in the market as being a big risk to not being in the market as being the big risk? Obviously, the quick answer to that would be, well, the bottom of the market, right? When you hit a bottom, we realize that, okay, now the risk of being out of this market is greater than being in the market because markets already come down and reach that bottom. But unfortunately, we never know when that bottom is. And so I have maintained throughout the declines in the S&P 500, declines in the TSX, and all the major indices in North America, I've maintained this whole time that you need to stay in this market. Use this as an opportunity to better your portfolio. Buy good quality investments that are on the cheap. Buy good investment ideas that are paying a very good dividend while you wait for the growth to come. And this is key. And I've been saying this time and time again, because I can't tell you how many calls I received from individuals saying, should we be getting out of the market? Should we move to cash? Should we buy bonds, GICs, other investment ideas because things look really bad out there? I can tell you from time to time, they do look bad. We saw it look bad in 2008, 2020, 2022, 2000 with the tech bubble bursting. We've seen this many times before. And what happens? The market moves higher at some point down the road. And not only does it move higher, it makes new highs at some point. Let's take a look at our first chart. And I think this chart sums it up probably best. This is a chart. It's called the investment emotion cycle. And you can see right in the middle of the chart, the point of maximum risk is when everybody is happy. And I'll just go through the chart very quickly. So on the far left, you have, it's still early days. I'll keep my eye on the market. It's starting to move higher, but it's still early days. Then the next point looks like there's real support. I'll invest soon. And then the third point, I've missed some gains, but I'm going to buy. And then at the top, good thing I didn't wait any longer. And that's what I tend to see, right? You tend to see investors getting in at the point where they're like, oh my goodness, this is for real. We need to get in. Well, that is point of maximum risk, because in hindsight, when we look back, that would probably be near a topping point. Then right after that, well, market starts to move down a bit, just a small setback. I could always invest more, bring down my average. Then you get to, it can't go any lower from here. I'll sell when I'm above water again. And then finally, the person says, I've had it, I'm out. And I saw investors do that. Come beginning of April, a bunch of investors unfortunately got out at a low. And unless you get back in very quickly, that obviously is the wrong strategy, because at the bottom there, you'll see point of maximum fear is also the point where you have possibility for maximum gain. And then you have the saying there is, told you so. Good thing I got out when I did at that point, but that is the mistake. That is the point where things turn around and things get better. Our next chart, I've shown it before. It is a great chart, a lot going on here. This talks about value of $10,000 invested in the S&P 500 over a 20-year period, 2003 to 2022. So do the quick math, 20 years, 365 days a year. I know the market's not open every day of the year. That's about 7,300 days, 7,300 days. Most of those days, the market is open. If you miss just the 10 best days, your rate of return, if you don't miss those 10, you stay invested, rate of return of 10,000 over 20 years, 64,844. Market goes up, you basically 6 times your original investment, almost 7 times. If you miss just the 10 best days, look how much your rate of return gets cut by more than half, 29,708. And then the chart shows miss the best 20 days, miss the best 30 days, 40 days, etc. Until finally, I think if you miss the best, well, let's say 30 days, you're kind of, $10,000 invested would be about 11,700. So you're kind of flatlining. And if you miss any more days than 30 out of 7,300 days, a big number, then your return is actually less than what you started with. The note right in the middle of that chart says in 2020, the second best day happened immediately after the second worst day. And we know this. The best days come after the worst days, the best months after the worst months. Sometimes, and quite often, the best years after the worst. 2008 was a horrible year. 2009, the markets doubled. Investors doubled their money. Many did in 2009. The last part of this chart at the bottom, when were the 10 best days in the market over the last 20 years? You'll notice many of those days are in 2008 during the financial crisis. Many of them are 2020 during COVID. So again, this just continues to highlight, and I want to highlight this. And I know individual investors will forget during the next crisis, but I want to highlight that you can't sell out of fear. Stay the course, especially if you're selling to get back in. It's always easier and easy to sell, but it's very difficult when to get back into this market. And that's the main message I want to get across. I'm not saying we're home and free right now. Obviously, anything can happen. Another tweet, another announcement out of the White House could take this market down. If trade negotiations go sour, yes, this market can go down. But I think we are at a turning point in the trade war. I've maintained that for a bunch of weeks now. And I really believe that as investors, you can't panic, stay the course, buy good quality. And I think over time, as we know, markets do move higher. So what are the pluses and minuses of these trade negotiations between U.S.-China announcements, U.S.-UK announcements? What was affected? What did we see? Where did we see the effects? Well, they had a lot of effects, actually, and we'll go through them pretty quick. First effect was on oil. I brought it up a little earlier. WTI, our first chart here, shows, we can pull it up, there it is. We can see that oil was falling, right? President Trump has talked about bringing oil perhaps down to $50 a barrel. WTI crude, Brent crude, which is the crude that is in Europe, that would follow. But the overall idea was to bring down the price of oil. My opinion, I believe the United States, with their close ties to Saudi Arabia, which we just saw and was on display just yesterday, I believe the United States has asked the Saudis to increase production, to ask OPEC to increase production so that they can bring down the price of oil. I know there was some talk about cheaters in oil production. It was to go against some of the cheaters in OPEC and all that. That may be the case, but I think the overriding idea that I have was that the United States is behind bringing the price of oil down. The reason why we've seen the price of oil spike when the China-U.S. negotiations were announced and the tariffs were reduced was because now trade can begin again, can happen again. The global GDP numbers, if a trade deal can happen with China and the US, I think they will go higher. And as we know, GDP goes up. If growth goes up, more energy is needed, and the price of oil should go higher, at least initially. I still maintain that the United States is going to produce more oil. OPEC will produce more oil, and eventually the supply of oil will be larger than the demand, or at least match the demand, maybe slightly exceed, and we will see oil prices fall. The next, I guess, part of the markets that I've been hearing a lot about has been the idea of gold. Allan, should we buy gold? Well, gold has been a fantastic investment. You can see the huge run-up that we've had in gold, really since the start of the year. Unbelievable. It's probably the only thing that has gone up this much. Nothing really that I can think of. Maybe recently we've seen crypto Bitcoin move up quite a bit, but gold has had a great run-up. However, when you announce a trade deal between, or at least negotiations between China and the US, that is good. Good for America, good for the US, good for the US dollar. US dollar rises, which we'll see in a moment. And with that, price of gold comes down. There's not as much chaos in the world, not as much uncertainty in the world with a 90-day pause. Once again, price of gold falls. And before we came on the air, gold was down again today, about $60 an ounce. So we're really seeing the price of gold take it on the chin. I think it got as high as $3,500 an ounce, and now we're seeing it under $3,200. Our next chart, again, talks about the dollar and how the dollar has started to gain a little bit of strength. On the far right-hand side of this chart, it has gained strength versus the Canadian dollar and all the major currencies around the world. Canadian dollar now is back down to just over 71 cents. And you'll see it on our next chart here. We can show it. Canada-US spot exchange. There you go, a year-to-date chart. You could see that for a while there, the Canadian dollar rose versus US, then dropped versus US, and now rising again based on the idea that US dollar again is doing well. You'll see right now, as I said, US dollar doing well, Canadian dollar falling a little bit recently, still not that unreasonable, still above 71 cents. But if a trade deal does happen, in my opinion, or if when multiple deals happen between the US and other countries, I really believe that we could see the Canadian dollar or the US dollar gain strength against all major currencies. And our Canadian dollar just may fall down below 70 cents again on this idea that our economy may not be doing as well and struggling a little more than the US economy. So to me, keep in mind, what do trade deals mean? Not just good for GDP, seeing GDP growth. We're going to see global growth go higher, but it affects many different things. It'll affect interest rates. It'll affect what Fed says, and we'll talk about that momentarily, what the Fed can do. It'll affect gold prices, oil prices. It has a huge effect on many different areas of the markets, of the economy. And I think for all of us, we just got to keep everything in perspective. And what do trade deals mean? Well, it means that there are a lot of moving parts. So we'll see what happens over the coming days, because we know that 90-day pause on reciprocal tariffs, I believe, ends at the beginning of July. So maybe we have just over a month left, and we're going to have to see a lot of trade deals happen in the next month. So keep an eye on these trade deals, and keep an eye on things such as gold and oil prices. So as I just mentioned, when will the Fed take action? When will they cut rates again? We know they cut back September last year. They cut a couple of times towards the later half or the second half of last year. There was talk that in June they would cut rates again. And our first chart actually shows some of that talk. Right now, the talk is that they're not going to cut rates. And you can see here that everything should be maintained for the June meeting. Almost 92% now say that interest rates will not be cut from June. However, what we do know is that has changed, and that has changed based on, again, trade deals, trade negotiations, trade talk, because just, I guess, 1 month ago, and I don't know if we have that here, just 1 month ago, you could see the target rate. I think we can put up our next illustration. You could see that just 1 month ago, that okay, we don't have it, but I can tell you just 1 month ago, the percentage that the Fed was going to cut rates was as high as 64%. 64, almost 65% chance that the Fed was going to cut in June. And now we're sitting at, let's call it 20%, a 20% chance that the Fed would cut in June. So it's come down quite a bit, and that is because trade negotiations. The fact that why should the Fed cut? If everything is going well, and if we're going to get a trade deal between the two largest economies in the world, why should the Fed cut rates? And our next chart, which we now can pull up, that we just showed briefly, that shows unemployment rates. Unemployment rate, pretty steady, right? You're looking at 4.2%, roughly 177,000 jobs roughly created in the US. So we know that the Fed has two mandates: stable prices and full employment. Well, at roughly just over 4% unemployment, you're looking at pretty much full employment. The right-hand side of this chart, non-farm payroll employment, monthly change, and you can see the last few months have really not dropped much at all. A little bit of a drop, but not much of a drop at all. And our next chart shows the other half of the Fed's mandate, which is inflation. You could see the latest inflation, CPI, which came out this week, 2.8% on the headline and 2.3%, 2.3% on the headline, 2.8% on the volatile, or the, when you take out volatile food and energy, that you get the 2.8%. So headline is getting close to the 2% number. You're seeing full employment. You're seeing inflation falling to close to the 2% rate. So why would the Fed cut? Well, maybe you'll see the Fed cut if we start to see inflation below 2%. But with everybody anticipating, even with these trade talks happening, inflation, cost of goods in the US rising in the next quarter, let's say the next 3 months, I think that you're going to see the Fed sitting on their hands for the time being. Now the talk is that they may cut twice, but those cuts will not happen until the back half of the year, maybe September and maybe December. So when will the Fed act? I'm going to say probably not to the second half of this year, but obviously the data will tell what the Fed, or dictate what the Fed is going to do. So quick hits, three things that we've seen in the news recently that I want to comment on that some of you may have seen in the news. First one, Trump's China trade deal. Tariff pause means new surge in freight shipments and higher prices. We touched on that earlier in the show. Lower food prices tame U.S. consumer inflation in April. Tariff squeeze awaited. So as I just said, a lot of people looking for or waiting for that tariff squeeze, but we saw lower food prices. Some are pinning the lower inflation numbers, the headline number, the core number on lower food prices. And that's why we're seeing a drop in inflation in the US. And our third point, US car prices higher in April after tariffs hit. We're now starting to see the first cars coming to the US from other countries. And as we know, 25% tariffs being put on cars, on some of the parts that went into the car. So we're starting to see the automobile sector in the US be hit. We're seeing layoffs in GM and Ford, even Honda. Honda's talked most recently about not moving forward with their plants here in Southern Ontario to open up their EV plants and battery plants, etc. So that is obviously a negative for the market. So let's talk about our first one, trade deal between the US and China. What does that mean? Well, it means a surge in freight, right? A lot of the freight companies were going to get hit. We're starting to get hit. They were starting to see, not as much deal making, not as much movement of goods across the ocean, and obviously that was hitting. But it was hitting these companies. But now with a trade deal, or at least talks of a trade deal coming, one trade deal discussion, UK a lot further ahead. Trade deal with China, trade deal with many countries that we're hearing all over the world, whether it's South Korea, whether it's Japan, our U.S. biggest allies. Those trade deals may be announced in the not so distant future. And now, once again, hopefully for the U.S., we're going to start to see some of these freights, these ships coming into the ports in places like California full and as many ships as they're used to seeing. The second, quick hit we wanted to talk about is the lower food prices tame U.S. consumer inflation for the month of April. We have a chart here, annual price changes for U.S. consumers, and you can see housing was up 4%, other goods, medical care. Then you see the food and beverage, 2.7%, definitely not as high. All items in general, 2.3%. And you can see at the bottom, apparel was negative, transportation was negative. I think apparel is negative has definitely to do with the trade war with China and the tariffs that have been placed on places like Vietnam, where we get a lot of apparel from. I know Nike would be the first to tell you that. And so we're probably not getting as much in the way of goods from those countries. And that has caused inflation to go down in that area. So overall, I think definitely food and other areas have helped bring down inflation. And hopefully this could lead to perhaps the Fed being more accommodating in their interest rate policy somewhere down the road. Our third point that we wanted to talk about, a quick hit, and this has to do with U.S. car prices moving higher in April as the trade or as the tariffs have hit. Our first chart and only chart of this segment we have here, you can see there it is. And you can see new car prices did jump after tariffs were in place. And it's interesting chart because it talks about that yellowish line, the gold line is incentive percentage. So the incentives you can see on the far right-hand side for these automobile incentives for people to buy cars, those are them going down. And I think the reason for that is their margins have been getting more and more narrow. Margins on cars, definitely if prices are going up, it's going to affect margins, and therefore the incentives have not been as great. And that, of course, leads to prices of cars moving higher. So interesting what we're seeing. Obviously, the increase in prices are affecting the big three, whether it's Stellantis, Ford, GM, but it's affecting actually everybody, right? Anybody who's bringing a car, manufactures that car outside of the U.S., brings it into the U.S., you're going to be hit with some 25% tariff. We'll see, what happens going forward, what the negotiations will look like with certain countries, and hopefully these tariffs can come down and make business a lot easier, between countries, the U.S. and all the countries all over the world. So now I want to take one question from our audience. Again, I always try to find the question that is most relative to our show today. And it is, here it is, a good, very good one. In a recent show, you mentioned that you're now hunting for and investing in greatly discounted stocks. Do you have any recommendations for investors? A fantastic question. So the first thing I will say, the greatly discounted stocks are not discounted as much anymore. We've seen the markets rebound to break even. In fact, the TSX is actually slightly positive on the year. So the discounts of 20, 25, 30 and beyond percent are now 15% discount, still 15% discount nonetheless. And I think you can find these discounts still in the same areas as I've mentioned in the past. Technology, bank, there are some big discounts in pharma. A lot of retail names are trading a lot lower. So I think you can find them in all areas. I think as an investor, you just got to continue to do your homework. I think investment advisors, that is their job. So if you have an investment advisor and you have some money to invest, give them a call. Ask them what looks good right now because you have some money that you want to put to work. Because as I always say, you should always be an investor in this market. You can never time the markets. But a few weeks ago, when I sent a message out to many investors saying that you always want to invest, but right now there were a lot of bargains to be had at that time. Well, I guess we hit the nail on the head then, because since then, a lot of investors have been buying, a lot of money has gone into the market, and prices have moved higher once again. So with that, I want to say thank you to everybody that tuned in today. As always, hopefully you took away something from our show. I want to thank everyone for taking the time out of your busy day, spending a little bit of time with us, the last 45, 50 minutes or so. And I want to say that I hope you all tune in 2 weeks from today, 12 noon once again. We actually will have a guest on our show. That will be Wednesday, May the 28th at 12 noon, when we're joined by David Patterson. He's the Ontario representative in Washington. So this person is in charge, or at least responsible for, the negotiations between Ontario and Washington. An interesting person to talk to at this time. So please tune into our show in 2 weeks, 12 noon, right across all online platforms, from Twitter to Instagram to Facebook and the like. And we look forward to seeing you again in 2 weeks. And until then, happy investing.